Hello, hi. My name is Jerry Miller from Trendsignal, the trader education company. This is part of our Monday Market Insight series, and not surprisingly, I'm going to be talking about the dramatic fall in sterling and the significant rise in UK gilt yields, which has implications for us consumers, mortgages, etc., but also with businesses that borrow in the capital markets. Crisis in sterling. It is a crisis. I know it's rebounded somewhat towards the end of last week, and also the sovereign bond market have been seeing some frenetic selling ever since the so-called mini budget unveiled by Kwasi Kwarteng, our new Chancellor. Our Chancellor has only been in the job for, what is it, 3.5 weeks, when it was unveiled in the Commons on Friday, the 23rd of September. So the first question is, why did sterling and then UK bonds, referred to as gilts, start to fall? I want to start with by looking at a chart of sterling. So this is a daily chart of sterling against the dollar, and you can see the precipitous sell-off. This cursor that the bar that the cursor's over at the moment is the Friday the 23rd, the day of the mini budget, so-called mini budget. It was just a sort of announcement, really. The following Monday, after Kwasi Kwarteng was interviewed in the press over the weekend, he said that this was only the start of his tax cuts, and I think the market just went into a nosedive on Monday morning. Sterling actually hit an all-time low of 103.30 right down here, which is hugely significant, really. Since then, it's recovered. It's a very crowded trade. A lot of hedge funds and other big trading groups were feasting off it and had made a lot of money. But since then, it's been squeezed back higher as the UK central bank, the Bank of England, intervened into the gilt market to prop up prices. I'll get on to reasons why they did that in a second. So sterling is really a barometer of health of the UK economy, you could say. With these tax cuts, it'll require additional borrowing by the UK government. And I think investors were pretty quick to realise that the UK would have to increase its borrowing significantly. And I think it was the loss in confidence in what the Chancellor was planning is the initial cause, or you could say the spark, that caused a deeper and even a very large jump in gilt yields. And so next, I just want to quickly show you what we mean by a jump in gilt yields. This is a page from the Financial Times on their market section, and all it shows you is the thing I'm looking at, for example, here is the 10-year gilt yield. And as you can see, the brown line depicts where the yield was a month ago, so exactly a month ago, last Friday, that is. A week ago, it was 3.85%, and it's now currently, it closed on Friday night at 4.17%. I can tell you that at its highest yield, before the Bank of England intervened last week, it got to about 5.55%, which is hugely significant because at the beginning of last week, the yield was around 3.5%. So you can see how significant a jump it was. Sorry, the beginning of the previous week, so a couple of weeks ago. But it then jumped to 4.55, which, to have a whole 1% or 100 basis point rise in yields of any bond is hugely significant, especially for a country such as the UK, which normally has very stable bond markets. So this loss of confidence, let's get back to my charts, to my slides. This loss of confidence with the Chancellor has caused a lot of problems for the markets. The additional supply of new gilts, coupled with, I suppose you could say, the inflationary implications of these tax cuts, I think is the root cause of these moves. However, I think there are more significant issues here with the pension industry, and the pensions use something called leverage trades or derivatives, and it's ironically these leverage trades or derivatives were used to actually hedge against big moves in bond yields, and it was these big bond yields, the gilts that were rising in yields that forced the UK pensions to sell gilts, and it's they use something called this liability-driven investing model, or LDI, which basically tries to balance their liabilities with their assets, and they use derivatives to do it. And effectively, as yields shot higher, they had some very big margin calls, which is basically they need to put up more money with their counterparties to finance these positions. And they didn't have that money, and it meant they had to sell assets. And the first thing that the pensions thought to sell were the actual bonds, because the bond market is the most liquid market that they could tap. And so that sort of resulted in more falls in bonds, the yields rising even higher, which forced even more bond liquidation. So you could see they were stuck in this spiral of higher and higher higher yields, and that's the reason why the Bank of England stepped in. And they stepped in and bought 65 billion pounds worth of medium-dated gilts just to stop the rot, and it did. But it really just goes to show you that this LDI model, or liability-driven investing, LDI, is has its flaws, has its significant flaws, absolutely. Anyway, it broke the cycle of selling, I think, but there's been a lot of damage done to the UK sort of markets and also the credibility of the pension industry to a certain extent, I'd say. So, what next? What are the consequences for this fall in sterling and jump in gilt yields? Well, it should be noted, I guess, that the rush to short sterling, or sell sterling, I should say, which drove sterling down to an all-time low of 103.30 on Monday the 26th, it resulted in what we describe as a very oversold trade, where a lot of big funds, investors, have actually shorted sterling or sold sterling. And what we've seen since then is that squeeze back up in sterling in that chart we were looking at a few minutes ago. And that's what's caused sterling to recover. Sterling will likely remain under pressure because the Office of Budget Responsibility, or the OBR that you'll see referred to in press, have said that they won't be releasing their forecast of this new government's tax and spending plans until the 23rd of November. That's a long time to go. And I think it's likely that the markets will continue to speculate and be driven by rumour, and the date when the BOE cease to support the gilt market, which I believe is in a couple of weeks' time. So I think the consequences of a weak sterling are inflationary. Much of the world's goods and commodities are priced in dollars and some in euros. And I think that will mean all those imported goods, imported services will be costing a lot more, and those costs will be passed on to consumers. And that's what inflation is. And I think, the big story is the general strength of the US dollar. We know that the dollar's been rallying against all currencies for the last sort of 9 months to a year, and it's strengthened even more against sterling over the past 2 weeks. In fact, over the past 12 months, sterling's fallen from about 135 to the dollar to, well, as low as 103.30. We've just been looking at that. The rise in gilt yields, as the price of these gilts fell, is also a costly business for consumers and businesses alike. Gilt yields rocketed higher last week, touching 4.5%, as I've said, and pension funds rushed to sell. Banks and mortgage providers price their mortgage rates for us consumers off the gilt yields. So, you can only imagine what's going to happen to the interest rates now on these mortgage deals, and I believe last week a record number of these mortgage deals were pulled last week as these gilt yields soared. In fact, something like twice as many were pulled last week as in the worst part of the market meltdown when COVID struck in March 2020. So, with new mortgage deals, when they're published, the interest rates, I'm sure, will be significantly higher. That'll be tough for consumers and will mean households will have less to spend. Businesses looking to tap capital markets when they want to borrow to finance their businesses will also find that the interest rate they've got to pay to secure these funds have jumped. This will lead to cost pressures and inevitably pressure for these businesses to pass on those costs and raise their price of their goods or services that they sell to us consumers. It's just all inflationary. Finally, will the government change course? Will sterling gilts remain under pressure? I think it's quite clear that the government has totally underestimated the reaction to their plans. The Economist newspaper believes that the Truss government is doomed and that she or Kwasi Kwarteng will likely be forced out. Poll ratings are a disaster, and as things stand, all the markets and the general population knows that the cost of this massive tax giveaway is just not right. Most would agree that it's not right, not the right time to be giving tax breaks to the well-off, no matter how this could be justified economically. I think the people believe it's not right, not fair, and the readings suggest that there are many Tory voters that are deserting the party, with Labour gaining an astonishing 33-point lead over the Tories in a poll published at the end of last week. Will sterling and gilt prices remain under pressure? Well, the markets, I should say, will have the last word, I'm sure, and I think force Truss and Kwarteng to change their plans. It's then likely that we could have another leadership. I think the problems with changing their plans is that they'll have lost all credibility. The markets will be skeptical anyway. So I think it's likely the outcome of that would be a challenge through the backbench 1922 committee again, and I think Truss and her government would be forced out. And I think it's only then will the markets recover, only with a change in course regarding these costly and inappropriate tax and spending plans. I think will sterling and gilt yields recover. That's really it. Thanks for listening. Yeah, bye for now.